Oil prices rising for 6 straight weeks, and today's gains driven by Saudi Arabia and Russia's decision to extend production cuts. Remaining OPEC Plus members, though, deciding to keep output unchanged in a meeting today, causing prices to rally further. It comes as extreme weather poses threats to U.S. production. Let's bring in Andy Lipow, president of Lipow Oil Associates. Andy, good to talk to you today. I'm looking at where oil prices are trading today, oil futures, I should say, above that $80 a barrel mark. How supportive do you think these cuts announced by Saudi Arabia as well as Russia will be in terms of price action?
Well, thanks for having me. I think these cuts are very significant. If we look back to October of last year, OPEC Plus has cut over 5 million barrels a day from their production quotas. And these last voluntary cuts by Russia and Saudi Arabia really emphasize the point that they're looking for higher prices because the domestic budgets of these OPEC Plus countries simply could not last when oil was under $70 a barrel.
So, Andy, do we expect to see oil hit $90 a barrel before the year is out?
I think there's a very good possibility, especially as we've seen Saudi Arabia take these proactive steps to get the price of oil higher. I think they'd be quite comfortable to see Brent crude oil prices at around $90 a barrel and WTI at about 85. But the market could move higher because OPEC Plus tends to be reactive. And of course, as prices rise, they're certainly going to think it's in their benefit to keep those higher prices higher for a longer period of time without triggering a recession around the world.
Andy, what are the supply-demand dynamics looking like right now? You know, on the one hand, we've got the prices above $80 a barrel. You've got the Russian cuts taking shape more. And yet you look at the demand picture, at least in China, where the biggest market is, we just haven't seen the kind of pickup in economic activity.
Well, I think that their economic activity is lagging, but we do see in the physical oil market, China is buying record amounts of crude oil and processing record amounts of that oil in their new refineries and existing refineries. So the oil market is seeing the demand. The latest cut of 500,000 barrels a day by Russia was actually impacting China at the most, because China, India, Turkey, and Bulgaria have become the 4 main customers of that Russian oil. So it does look to me like inventories around the world are declining and supplies are getting tighter.
Andy, I want to ask you about just the impact of heat. It's not something, over the years I've covered crude oil, and it's not something that's been often in the conversation when you're talking about oil prices, oil inventories. What is the impact of extreme weather on that market?
Well, there's a number of impacts. The first is that in the Middle East, we see them burning more crude oil for power generation to run their air conditioners during the summer. As far as refinery operations go, refineries, like people, do not like it when the heat index is 110 to 115. They simply can't have the equipment work as efficiently. And as a result, they're cutting their operating rates, not only here in the southern U.S., but in places like Greece and Italy, where temperatures are even higher than what we see here in Texas.
So when you think about, refineries having a breakdown, I mean, this is already coming at a time when U.S. inventory is low. To what extent is this, as in the factor with the heat, driving prices higher?
Well, it certainly exacerbates the problem, along with these refinery unscheduled outages that we've seen around the coast as well as in the Midwest. So as gasoline demand has increased about 3% over the last 4 weeks compared to last year, and inventories are declining, it makes for a mix of higher gasoline prices for the consumer.
Andy, I want to ask you about this. I've seen the Biden administration delaying some plans to restock the emergency oil reserves, given where prices are. They've canceled this planned purchase, the Energy Department canceling this this week. So what does that say to you? Is that a good move? I mean, considering, especially given that you see WTI heading towards $85 a barrel. What's your thought on that?
I think that the Biden administration is very focused on gasoline prices because it's such a pocketbook issue. I think the fact that the administration canceled these strategic petroleum reserve purchases of 3 million barrels a month, they're really very small in the scheme of the oil market. It's less than 100,000 barrels a day when world oil demand is over 100 million barrels a day.
Looking at gas prices right now, Andy, I'm looking at $3.80 right now a gallon. We have seen that number continue to tick up over the last few weeks. Are we going to see it push even higher going into year end, or is this just something that we're seeing given the inventory picture right now?
Well, I think over the next couple of weeks, we could see gasoline prices tick a little bit higher. We've got the bulk of the hurricane season ahead of us in the Gulf of Mexico. But as we get into the winter months, being October for the oil market, we see that refiners are able to make the cheaper grade of winter gasoline, and that would mitigate further price rises.
All right. Andy Lipow, president of Lipow Oil Associates, thank you so much. And have a great weekend and try to stay cool in Texas.
Thanks very much. Appreciate it.